Hi everyone, in today's video we're going to discuss Chapter 3 of The Intelligent Investor. In Chapter 3, Benjamin Graham analyzes a century of stock market history in order to extrapolate some useful insights to guide future investment. As we will see throughout the video, this is no easy task for a variety of reasons. I'd like to start this video with an interesting passage from Chapter 3, where Benjamin Graham quotes Aristotle Ethics. There is a fine passage near the beginning of Aristotle's Ethics that goes, "It is the mark of an educated mind to expect that amount of exactness which the nature of the particular subject admits. It is equally unreasonable to accept merely probable conclusions from a mathematician and to demand strict demonstration from a narrator. The work of a financial analyst falls somewhere in the middle between that of a mathematician and of a narrator." I like this subject because it captures the in-between nature of the financial analyst's work. So let's move on to the heart of the chapter. In this chapter, Benjamin Graham analyzes a century of stock market history, as I said. However, I will omit to discuss some of the things dealt with in the chapter, and I suggest you read the entire chapter because it's a great book. I will drop a link in the description below. However, in this video I will focus on the things I believe are most worthy. In particular, in 1963 there was a general optimism based on recent past record of the stock market. Benjamin Graham describes this phenomenon as a quite illogical and dangerous conviction that equally marvelous results could be expected from the common stocks in the future. Few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone. I like this passage of the chapter because it's a very common situation. Whenever the market is going upwards, people expect it to be higher and start investing even more. Whenever the market is going down, people don't want to invest, even though it should be the opposite. Benjamin Graham, of course, provides in this chapter and in later chapters the medicine to this irrationality. Long-term investment. In particular, the book is packed with charts, graphs, and numbers. And referring to one of them, it says that the full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. So the general takeaway from this passage is that by investing long-term, instead of day trading or keeping the stocks just for a few months or 1 year, you offset the possibility of being wrong in the short term. Because considering big, well-diversified index funds such as S&P 500, it is obvious that the general long-term trend is upwards. Another interesting concept that is introduced in this chapter by Benjamin Graham is the P/E ratio. The P/E ratio can be defined as the ratio for a valuing company that measures its current share price relative to its per share earnings. Of course, a P/E ratio can also be applied to an investment fund, even a well-diversified one such as S&P 500 that tracks the market. When you apply the P/E ratio to a well-diversified stock index fund that tracks the market, that is a simple tool for taking the market's temperature. So if you get a low P/E ratio, probably we are in a bear market. If you get a high P/E ratio, we're probably in a bull market. Later in the chapter, Benjamin Graham discusses why P/E ratio in and by itself is not enough to determine whether we are in a bear market or in a bull market. But in this chapter and in later videos, we will discuss how to use these numbers to achieve adequate returns. By the end of the chapter, there are some general suggestions for the 1972 investors. These conclusions are relevant also for the modern time investor because they apply some general principles. In particular, it is interesting that Benjamin Graham, in a moment such as 1972, where the market price is considered very high, suggests not to go for speculative operations such as buying securities with borrowed money He also suggests to reduce the common stock holdings percentage in your portfolio. Why is that? Well, the reason behind these suggestions are clear. Even though the P ratio of 1972 is not particularly high, interest yield on high-grade bonds is extremely high. These two conditions combined provide a good indication that the 1972 stock market was particularly high. That's why I suggest to refrain from speculative operations and from buying too many stocks. In doing so, Benjamin Graham shows how prophetic he can be, because he is able to predict the catastrophic bear market of 1973-1974. To conclude, I'd like to highlight the key takeaways of this chapter. Takeaway number 1. Never forecast the future exclusively by extrapolating the past, especially the recent past. Takeaway number 2. Recent past growth doesn't always bring equally marvelous results in the future. Takeaway number 3. Long-term investment offsets year-to-year fluctuations, leaving a positive picture of persistent growth. Alright, thank you for watching, and don't forget to subscribe and watch my other videos on the intelligent investor and on finance. Bye everyone.